All right, friends, welcome to you all around the world. Welcome to episode number 460 of the Follow the Money podcast. Great to have you here today. We're going to be talking about a very crucial topic that affects all of us on today's broadcast, and that is inflation. In today's world, understanding inflation is more than just knowing about rising prices, which we can see when we go to the grocery store or wherever we go. But it's really about safeguarding our financial future. And that's why this episode is dedicated to helping you inflation-proof your finances. That's what we have titled today's episode. And we're going to explore some effective strategies that we've been teaching here for years about how to protect your savings, your investments, and your income from the eroding effects of inflation. So on the very first segment today, we're going to break down our exclusive DSL strategy, a savings strategy that helps you diversify your emergency funds in a way that shields you from inflation over time. We're also going to discuss the PACE investment strategy that we've been teaching now for well over a decade. It's designed to not just survive, but thrive during inflationary periods. And then we also won't forget about your income. We're going to share actionable advice on creating inflation-resistant income streams. Then in our second segment, we're going to provide an up-to-the-minute overview of the financial markets. We'll focus on the S&P 500, physical gold, the dollar, and Bitcoin. We'll offer some insights into their current trends and what they could mean for your strategy. And then finally, we'll wrap up with some concluding thoughts that tie it all together, empowering you to take control of your financial destiny. So whether you're a seasoned investor out there or you're just starting out, there's something inside this episode just for you. So let's get started and dive into how you can protect and grow your finances even in challenging economic times. Follow the Money podcast. Here in our very first segment today, we're going to be tackling how to inflation-proof your finances. You know, inflation is not just a statistic. It's a silent threat to your savings. It's been called a stealth tax upon those who it infects. And it doesn't just affect or threaten your savings, but it threatens your investments. It threatens your income. And I want to encourage you to I just want to encourage you today through this podcast episode, because we do have strategies to help you not only protect, but also potentially enhance your financial well-being in the face of elevated prices like we've seen. Now, before we get into the strategies in this first segment, I want to briefly define what inflation is, because oftentimes that is not really understood. Typically, what we have heard from what we would call Keynesian economics, I don't want to get too much in the weeds, but Keynesian economics is pretty much the prevailing view of economics in the world of academia. And if you ask a Keynesian economist what inflation is, well, they will generally tell you that that inflation is a rise in the general prices of things, right? So in other words, the general price level, when that increases, well, they say that's inflation. Well, that is certainly true to an extent, right? So you do have rising prices, which we could call inflation. But instead of simply seeing the symptom and saying and calling that inflation, perhaps we should look at the root of the tree. And when we look at the root of the tree, we find out that the cause of inflation, or the cause of rising prices, is actually due to an increase in the money supply. So when you increase the amount of money in any system, well, you're automatically and if you don't increase the number of goods, if you just have the same number of goods or the same number of houses or whatever, well, then you're going to have a higher price of things. Things are going to rise in price. And so it's just basic common sense that when you spike the money supply, when you raise it, well, you're going to raise prices by default. And that's exactly what we have seen since late 2019. We have seen an incredible spiking of the money supply. And it takes time, what we call the lag effect, for both the money supply to work its way through the system, and then, of course, for the Federal Reserve, which tries to tamper down the effects of that increased money supply through its policies, there's a lag effect, right? So things in economics just don't automatically happen. They take time to play out. And so inflation, what we're dealing with here is a rise in the money supply. Well, the Federal Reserve here in the United States, has been doing what it can to bring back the money supply or dial it down. And they do that through interest rate hikes. And so by raising the interest rates, which we all know they have, this is one of the levers that the Federal Reserve has to tackle these rising prices. And how does it do it? Well, it lowers the money supply. It lowers the money supply by causing money to flow out of consumers' pockets and into the banking system because they're being promised higher rates. And that basically serves to drain some of the excess money that's out there that's causing higher prices to then come into the banking system. And that's really how it works. It's a little 101. It's a very basic overview. It's much more difficult than that, much more complex than that. But that's just a really quick thumbnail sketch of what inflation is and how the authorities deal with it. Now, you and I don't have the ability to raise interest rates and lower interest rates and raise the money supply or lower the money supply. What we have to do is deal with it all. We have to deal with the fact that all of these things are happening outside of our control. And the only thing that we have control over, of course, is our own finances. And so today on this very first segment, or in this very first segment, I want to talk about some of the strategies that we've been talking about for years here for our members and for even right here on this broadcast of things that you can do. So let's first up talk about your savings. We're going to talk about savings, we're going to talk about investing, and we're going to talk about income in this first segment. So when it comes to your savings, well, what can you do? Well, you've probably heard the old saying, don't put all your eggs in one basket. Well, when it comes to inflation proofing your savings, diversification is key. And that's why we have taught something we call the DSL strategy. And DSL stands for Diversified 6-Month Liquid Savings. The D stands for diversified, the S stands for 6 months, and then L stands for liquid. So we want to keep this liquid, we want to have 6 month savings, and we want to diversify it. And so by spreading your emergency savings across a few different asset classes, you can actually reduce the risk that inflation will erode the value of your cash reserves. Now, we've created a big study on this. We first put this out in our book, Bankruptcy of Our Nation, many years ago. But we updated the study about a year ago, and you can find the whole study on our website. It's pretty lengthy, but you'll find it all on our website at followthemoney.com/DSL. And what we do there is we break down how this particular strategy works. Now, remember, when we're talking about savings versus investing, savings is all about emergency funds, basically having money so you don't have to rely upon credit cards as much as whenever a need for cash arises or whatever. Also, it serves as an opportunity pool of capital, allowing you to take advantage of opportunities that those without cash, liquid cash, may not have. Your emergency savings here, your DSL savings, is not retirement savings. It's not education savings. It's not even an investment. So, that's not what we're talking about when we talk about savings. But when it comes to savings, what we have found is that if you diversify that savings, and especially considering you're going to have this savings for a long time, once you build up your 6 months liquid savings, as we talked about in our 5 levels of financial freedom, which you can find online, followthemoney.com/5 levels, there you can learn about how we propose that we diversify this savings. And 1/3 could go into US dollars, like a savings account or a money market account. Another third could go into physical precious metals. This is what we do. And then another third could go into stable foreign currencies like euros or Swiss francs or Canadian dollars. Now, this works out over time. We've done some different back tests, and we have found that if you held your money in a savings account over time versus if you actually diversify even a little bit of your savings, you're actually going to get a much better return. Now, remember, savings, your liquid savings, we're not really trying to get a big return. That's not really the goal. It's not an investment. But at the same time, we also realize that inflation is eroding even your savings, not just your investment, but your savings. And so doing all that you can to diversify that in such a way that is prudent can really be helpful. And so if you go onto our website, followthemoney.com, I'm not going to tell you all the details here, but it is pretty stark. It's pretty amazing that over, 5-year periods, 10-year periods, 20-year periods, 30-year periods, what happens to the DSL savings versus regular savings. And I think you'll be shocked. It's pretty powerful, especially when you consider that, precious metals now, like gold, is at a brand new all-time high. We also updated our study to say what happened if you added just a little bit of Bitcoin to your liquid savings. What if you had just like 5% of your liquid savings in Bitcoin? What would that do to the overall return over time? And it's pretty remarkable. So anyway, I encourage you to check that out. Remember, savings is not the same thing as investments. You want to be very prudent whenever you're diversifying your savings. And that's why we've created a lot of great info for you. Again, you can find that online, followthemoney.com/DSL. So remember, that's a really powerful strategy. Now let's shift gears and talk about your investments. Now, when it comes to your investments, you also want to protect that against the ravaging effects of inflation. And one of the strategies that we have been talking about for many years is something we call our PACE strategy. So the PACE strategy is a powerful way to think in terms of inflation proofing your investments. And PACE is an acronym, just like DSL is an acronym. PACE is an acronym, and it stands for P stands for precious metals, A stands for agriculture, C stands for commodities, and E stands for energy. We could also probably throw real estate into this mix as well, because over time, real estate tends to also serve as a buffer against inflation. But let's just focus on these four. So the PACE strategy basically teaches you that, look, you don't want to fully over leverage in this area, but if you're trying to get inflation protection in your overall investment portfolio, then these are some of the things that you might consider, especially during times of elevated inflation like we've been facing over the last few years. So PACE, again, P standing for precious metals. There, of course, we think of gold. Gold, which is a traditional hedge against inflation, and I would say, quite frankly, a critical component of a diversified portfolio. Here we have gold now trading at new record highs. We've never seen gold trade this high. Anyone who has ever bought gold over the last 5 years, 10 years, 20 years, 50 years, it doesn't matter when you bought gold, everybody is in the black now because the price now is reached above $2,400 as of this recording per ounce. So gold certainly does play a role as a hedge against inflation. And that's something that you would think about when you think, how am I going to protect my investment portfolio against inflation? So obviously precious metals is one. That's the P in PACE. The A in PACE is agriculture. This one can be a little more tough to get exposure to. There are some ETFs that provide exposure to agricultural commodities, but we've certainly seen different commodities do very well during this recent inflationary period. I'm thinking of things like sugar and cocoa, right? Some of these different soft commodities have really done well in this environment. And then we also think that's the A in PACE. And then we think of C. That C stands for just commodities, broadly speaking, which includes many different basic materials. And we've certainly seen commodities do well in this environment. Not every single commodity, of course, but many have. And then when we also think about PACE, we think of the E, and the E stands for energy. And so when we think about energy, we're thinking about oil, we're thinking about gas, we're thinking about different forms of energy. And these, historically have, all four of these areas have historically provided some benefit for those who are invested against the ravaging effects of inflation. So again, not piling all into these, different types of investment or asset classes, but just knowing them. PACE is a simple phrase or a simple word that you can keep in your mind, that this acronym reminds you of different things that can protect you from inflation and that historically have. So when it comes to savings, we think of DSL. That is diversified 6-month liquid savings. You can find more about that on our website at followthemoney.com. DSL. And then when it comes to your investments, we think of PACE, PACE, precious metals, agriculture, commodities, and energy. 4 areas that can provide you some insulation from the ravaging effects of inflation. Now, the final aspect of inflation proofing your finances has to do not with savings, not with investing, but what? With income, right? With your income. And so we want to consider your income. Now, inflation can eat away at your purchasing power. I've often said that it's important to remember that, a dollar bill is not worth what it's going to be, 5 years from now. If you take a dollar and you take an apple and you put a dollar bill and an apple and you put them both on a table and you walk away for 5 years and then you come back, you're going to notice the apple has completely disintegrated. And you're going to notice that dollar bill is still there. And it will be deceptive because you'll say, well, look, there's the dollar. It's still there. And everybody knows what a dollar is. But that dollar is not worth what you think it is. It's lost value. It's perishable like that apple. You just can't see it. It's insidious. And so the point is that inflation can eat away at your purchasing power. And that dollar will not buy what it will buy 5 years from now, and vice versa. So it's crucial to have a plan for this, to understand this, and not to be caught off guard, because again, it is a silent tax. It is a stealth tax when we're talking about inflation. So it's crucial to have income streams that can be adjusted upwards in inflationary times. Let's think, what kind of income streams could we create that would actually help us keep pace with inflation? Well, the very first one that comes to mind, and quite frankly, my favorite income stream of all, is rental real estate. So when you think about rental real estate, this is a classic example. As costs rise and as inflationary pressures rage, rent prices can typically be increased. So as your costs of doing business go up, well, then you can, of course, raise the price of the rent. And as a landlord today, I have done that. In fact, I just renewed a lease for a couple who is in one of our rental homes, and our insurance went up during the last 12 months since they signed their lease. The taxes for that particular property went up. And so I was able to take those increases and pass it on to the tenant and say, look, here's your new lease, but it's going to be going up a little bit. And they understood, because this is how business works. This is how it all works. Now, notice, though, that because I had a property and because I was in that position, I was able to pass on those costs to my renters. Now, if I'm working at a job and the price of milk and eggs and everything starts going up, well, I can't just demand a raise. There's no way for me to pass those rising costs on to my employer. So when we think of employment income or W-2 income, well, that's not really a good inflation-proof income source, because my income may stay stagnant as prices rise. This is why it's important to have multiple streams of income so that you can offset those aggravating effects of inflation. So certainly, rental real estate, which I heavily promote to our members as my favorite income stream of all. I mean, I really do like rental real estate. To me, it is my favorite asset class, and it's been that way for a long time. But okay, so there you have that. Also, how about if you start your own business? Well, if you start your own business and you offer products or you offer services in high demand, well, that allows you to adjust prices in response to inflationary pressures. So as prices cost, things go up, as prices go up, as inflation rages, well, if you have a product or a service, well, you can adjust that price, right? So for example, many years ago, I used to have an appliance repair company. It was one of the very first businesses that I ever started. My father taught me how to repair appliances as kind of a trade, and I really liked the trade. It was a really neat trade. It was kind of exhausting having to drive all over town and running the service business whenever I was young. It would probably be much more difficult now, of course, but it was a great trade, and I think everybody should know a trade. I think it's very powerful. But anyway, the point is that, inflationary pressures had risen during that time, well, I would have been able to raise or slightly raise my prices for my service. I could have tacked on an extra $10 if gas was costing more, or if my parts were costing more, or my tools, or my insurance, or whatever. As a business owner, you can pass those costs on. But again, back to the W-2 employee. He has no such power. He has no such ability to be able to pass those things on. So he's kind of stuck. And so this is why it's very important to think about how you can find income streams in your life and create income streams that can go up with inflation, right? That you can adjust if necessary to battle inflation. And again, W-2 income is not that kind of income. You might get lucky and get a raise, but it's not built in. It's not guaranteed that you're going to get that raise just because there's inflationary pressures. All right. So, basically by taking proactive steps in these three areas, your savings, your investments, and your income, you can build a financial defense system that not only withstands inflation, but also thrives. Now, our members have a slew of resources regarding all of these topics. In particular, we have an income university here for our members. They have access to 21 different income streams that they can create both now and in retirement. So if you're looking for an income stream idea, like I wish I could find something to create some sort of income that I could, add on to my current income streams, well, we've got it. We've got all kinds of different ideas here. That's what we love teaching our members. So if you're not currently a member here at Follow the Money, you can go to followthemoney.com/join. Choose your plan and pricing. Check it out. We have a completely free, guaranteed money back guarantee is what I'm saying. So 100% money back guarantee. So there's nothing to lose. You can check it out and see what you think. But if you're looking to get inspired in these areas, we want to help. So check us out, followthemoney.com/join. All right, well, stay tuned as we move on to our next segment where we're going to dive into the latest trends in the financial markets and what they mean for your money. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back to the Follow the Money podcast. So great to have you here. Now let's take a closer look at the financial markets in our second segment today. Whether you're a seasoned investor or you're just getting your feet wet, understanding market trends is crucial, especially in inflationary times like we find ourselves today. And today, what we want to do is we want to zoom in on the S&P 500 index, which is beginning to break down after a slew of weekly gains, one of the best strings of weekly gains we've seen in decades. It's beginning to pull back. I also want to talk about physical gold, which is again at those new all-time highs. I want to talk about the U.S. dollar, which has also been resilient as of late due to some shifting inflationary expectations. And then I also want to briefly talk about Bitcoin. There's many other markets we could talk about. In fact, earlier this week on our Trends and Profits webcast, which is for all of our members, we went through a slew of different financial markets and charts on video and talked about those. In fact, we just put out a video to all of our members on that topic just recently called Charting the Pullback. So we're just going to give you a little glimpse here of some of the things we were saying when it comes to these different markets. These are all markets that can tell us a lot about what's going on, kind of putting our toe in the water and finding out, or maybe wetting our finger and finding out which way the wind is blowing. So let's take a look and first discuss the S&P 500 index. As I've mentioned, and by the way, you can go back to our last podcast episode, 459, where we did a big stocks and crypto update. Of course, that was a couple of weeks ago. So this is obviously going to be more up to date today. But the S&P 500 index is often seen as a barometer of the overall health of the U.S. stock market. And we've seen a lot of recent movements in the S&P. As I had mentioned, back in October, very late October, we staged a really big technical breakout in the S&P 500. And the S&P 500 is important, as I mentioned. It's that barometer. And 3 out of 4 stocks will tend to move in the direction of the S&P. So it's a really important index to watch. It's probably, or definitely, the most popular index for viewing U.S. stocks for those who are overseas. But we have had an explosive rally that took the S&P 500 from around 4,100 or so back in October of last year, all the way up to around 5,250 or so. So it was a very nice run over just a handful of months. Well, just over ever since we've entered April, we've begun to see a little bit of a pullback in the S&P 500, and we just recently lost what is known as the 50 simple moving average support area. The 50 SMA is what we call it. For those of you familiar with technical analysis, that's a very important area that you want to watch on the chart if you're trading. Well, we just lost that a few days ago. The price of the S&P lost that key area, and it's continuing to fall even as I record this broadcast. And we're currently on track for the third consecutive week of losses. Now, we have to remember, this comes after a slew, as I had mentioned earlier, a slew of weekly gains. So we are well due for a sell-off, and this sell-off is by no means something we should be surprised at, nor is it in any way, shape, or form a signal that the overall uptrend is over. We certainly have no indication of that from the current, price action in the charts. This is simply a healthy pullback, in our opinion, one that was well overdue. We were due for this. Now, if you look at currently at the S&P 500 index, you'll see that around 70% of the stocks there are all mostly in uptrend. So we're not really in a threatening situation here, seeing this pullback. In fact, I view it as an opportunity. I think it's going to be an opportunity going forward. Now, let's also talk about gold, because gold has really been catching a lot of attention and turning heads. We've seen even some big banks come out, Wall Street banks come out and say they see gold going higher. Goldman Sachs, for example, recently raised its price target for year end on physical gold from 2,300, which has already been surpassed, to 2,700 by year's end. Then we also had another bank, Citigroup, also predicting the precious metal would reach $3,000 per ounce over the next 6 to 18 months. Now, I do get a little bit nervous when I see some of these big banks who haven't really been talking about, gold suddenly begin talking about gold. And although they do talk about it, they often just don't publicize it very much. So we are beginning to see that people are noticing this ascent in gold. So even as the stock market is beginning to pull back, we're seeing gold prices continuing to power higher. And as of this recording, gold is sitting right around $2,400. Silver, by the way, sitting above 28. So we've really seen some nice price action in silver, in gold and silver, which was our expectation going into the year. Now, physical gold is the key area we're watching on physical gold would be the 2150 area. So as long as we hold that particular area, we suspect we're going to see more upside for gold. 2150 is not the only area we're watching, but it is a key area, and it's a key area for a few reasons. That was the key area that we just couldn't break past. In 2020, it served as a big area of resistance. In 2022, and then again in 2023, we tried and failed to get past that area. So it's a really key resistance area. And when something like that turns, when you break above that in a meaningful way, then that often becomes an area that will then serve as a stubborn support area, or like a stubborn floor for the price. So if we were to see gold pull back to 2,100 and then fall through it easily, well, that would suggest that maybe the strength of this rally is not what we think. But right now, we're continuing to hold well above 2,100, and we see more price, advances ahead for gold. Gold, again, has been that traditional safe haven in times of economic uncertainty. So when inflation rises, and the value of currency, if it falls, then gold often moves inversely to the dollar, right? Whenever that happens. So watching gold prices can give us clues about investor sentiment towards inflation and towards economic stability. We also have, obviously, geopolitical concerns. Those are difficult to discern about how they're impacting the market, and it's also difficult to discern how long they'll impact the market. But regardless of all of that, we do expect gold to continue having a good year this year. That was part of our 2024 market outlook, was gold and silver. We expected to be outperformers this year, and so far, so good. Now let's move to the U.S. dollar, because I wanted to talk about the U.S. dollar in this segment as well. The dollar has been showing some renewed strength, and the reason for that renewed strength in the U.S. dollar, aside from geopolitical tensions in Israel and Iran and Ukraine and all of the different areas that we've been seeing, of course, in Gaza, the horrific wars that we have been seeing, this is obviously putting pressure upon, investor sentiment. And it's causing people to wonder, where is all of this going? And that can cause people to look for safe havens, i.e. gold, but also the dollar in many ways. And it's interesting to see gold and the dollar both rising higher. That tends to be, like I mentioned, not usually the way that it goes. They tend to move in inverse relationships. But when you have times of fear, especially geopolitical fear, then you will have oftentimes see the dollar and gold both rising. Well, the dollar has been rebounding throughout the month of April, especially since the middle of April, largely due to those geopolitical concerns, but also because, as you may remember, earlier, or I guess it was last week, we had a inflation report that was put out, the CPI. The numbers came out, and they showed that inflation growth was slightly elevated above expectations by analysts and economists. And in fact, it was like 0.1% above where they thought it was supposed to be for the month of March. Well, this caused a big recalibration in the expectation for rate cuts, because it suggested that inflation was not coming down, or the growth in inflation was not coming down fast enough to justify rate cuts, which many investors were expecting by June. Now, when you look at the Fed futures market, it looks like we may not see a rate cut until July, or maybe perhaps even September. But it's difficult to really think too strongly about that, or have a strong opinion about that, because every data point tells a new story, it seems, this year. So we're going to get another inflation report later this month. It'll be the PCE number. That number is going to be very important to the Fed. That could change the trajectory. Then, of course, you're going to have an April CPI report. The problem is that we have rising energy prices, and that's a component in the CPI, of course. And so as those rise, then you have the concern there that we're going to see some elevated inflationary pressures, which could then complicate the picture for the Fed as it tries to lower interest rates. Obviously, the Fed is wanting to move back to a place where it can begin lowering interest rates, and that's going to be good news for borrowers. It's going to be good news for those, who want to buy real estate. It won't be great news for savers, of course, but overall, many people are looking forward to seeing lower interest rates. And until the Fed can get a handle on the current inflation rate growth, until they can see that that number is really coming down to where they want it to be, it's going to be difficult for them to justify any kind of rate cuts. So the dollar, the main thing I want to tell you about the dollar here is, if you follow the dollar index, the key area we've been saying for many months now is that the 106 to 108 range on the dollar index is the area that we do not expect the dollar to go past. So we are almost there. In fact, we're right now sitting at about 106. What this tells us is that we are likely going to see, can't guarantee because we don't have a crystal ball, of course, but we are likely to see the dollar begin to pull back from its recent strength, and that will provide a relief rally in equities and in gold even, and other things. So the strength of the dollar has complicated the financial markets in recent weeks, and it's also led to some pullbacks across the board. It's also, we've also seen a spike in the volatility index, which we did talk about at length on our recent video for our members. Now, lastly, we want to talk about Bitcoin, because Bitcoin, many people view it as digital gold. Many view it as a modern day hedge. I'm not so convinced about all of that. But what I am convinced of is that it's a very unique asset that we like to invest in for the long term at a very, with a very small allocation. Now, currently, as I do this recording, Bitcoin is sitting just above 60,000. Now, this, of course, is after it had recently hit a new peak of 73,750. So Bitcoin has really been on a tear this year, and it is still up very good. If you look at it, year to date, for example, Bitcoin's up 42%. That's trouncing pretty much every other asset out there. So it's definitely doing well in the current environment, but we have seen it pull back. Now, there are two major support areas that we're watching on Bitcoin. The first one is 59,000. So we expect that it's possible that Bitcoin will pull back to the $59,000 level and find key support there before it rebounds. Now, remember, the halving, as I do this broadcast, we're like 2 days away from the Bitcoin halving. And if you missed our episode on the Bitcoin halving, you can go back and listen to it. It was just a few episodes ago. We called it the Bitcoin halving effect. That's really big news for Bitcoin because it's going to slash the blockchain subsidy that's available to miners in half, which is effectively going to cut the inflation rate of Bitcoin in half overnight. That's going to happen in 2 or 3 days. And so when that happens, that typically leads to a bullish price action for Bitcoin. Now, it doesn't have to, but historically, that's what we've seen. Now, again, the two areas I'm watching on Bitcoin in this current route, in this current sell-off that we've seen, is I'm watching 59,000. I think that could be a very key area or floor for Bitcoin where it begins to rebound. However, if we see that area violated to the downside, and if we see that Bitcoin is not, holding 59,000, then the next major area of support from our vantage point is the $50,000 level. So we could see Bitcoin fall through 59,000, and if it does, it could fall all the way down to the $50,000 level. Now, I don't know if that's going to happen, but if that $59,000 area is touched and is violated, then I would expect 50,000 to be the next major area of support. Now, we remain very bullish on Bitcoin and gold and the S&P 500 through the end of the year. This is an election year, and historically, election years tend to be better than other years, typically. But they also tend to be a bit more volatile, as you can imagine. We're going to be hearing a ton of wild propaganda from both sides of the political aisle going forward, and everyone wishes this election was over, and it feels like it's just getting started. We're still several months away from Election Day here in the United States, but it is very agonizing to have to listen to all the propaganda over and over and over again. And as I tell our members, and I've been telling them for years, the best strategy for that is just to turn the noise off. You can really get a lot of information from just looking at the chart. In fact, you can look at a chart and oftentimes you will be able to tell what the news is. So anyway, there's a little bit of analysis for you on some of the different markets that we follow here at Follow the Money. If you're interested in following these markets with us, and if you want weekly updates and weekly webcasts and ongoing education and access to our trading and investing ideas, again, I encourage you to check out our website, followthemoney.com. You can go to /join, and there you'll see all the different plans and pricings that we have. We have plans for very low budgets and plans for those who really want to take a deep dive and learn all that they can. So I hope this segment helped you to make more informed decisions about where to allocate your resources and how to safeguard and grow your wealth. Stay with us as we wrap up today's episodes with some final thoughts to help you stay focused and motivated on your financial journey. We'll be right back. right, friends, welcome back to the final moments of today's very special Follow the Money podcast. And as we wrap up today's episode, we want to reflect on the critical strategies that we discussed in today's broadcast to shield your finances from inflation. So whether it's diversifying your savings, whether it's adjusting your investment strategies, or developing resilient income streams that can be resistant towards inflation, remember that these actions are not just about surviving. They're about thriving in an ever-changing economic landscape. Don't think that the inflation we've seen just over the recent few years is some sort of anomaly. You know, these are going to be challenging times going forward for all of us. Inflation affects all of us, subtly reducing our purchasing power year after year. Quite frankly, it's a form of robbery. And it's vital to stay proactive and informed so that your financial plan remains robust against this hidden force. So you want to keep reassessing your financial strategies regularly, perhaps an annual review of what your current strategy is. And then you want to ensure that that strategy aligns with current conditions and your future goals. So now, as a parting thought, I want to share with you a final word as always, and this time by the economist Milton Friedman, who, when he said, inflation is taxation without legislation. Right? That's a powerful statement. That reminds us that inflation silently yet steadily chips away at our financial freedom, much like an unseen or stealth tax. And it underscores the importance of being vigilant and strategic in managing our finances so that we can combat the stealthy impact of inflation. Very important that we stay proactive in these very challenging economic times. All right, friends, well, that's just something to think about, and I want to thank you for joining me today. If you found this episode useful, don't forget to subscribe to our podcast. Visit our website, followthemoney.com, for more insights and tools. We're here to help you make sound financial decisions that lead to lasting prosperity. Until next time, friends, keep investing wisely and guarding your financial future. This is Jerry Robinson from Follow the Money, wishing you great financial health. Remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial